Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we'll unpack inventory accounting, what goes into inventory, how it turns into cost of goods sold, and how to keep it measured and valued correctly so your profits are real, not wishful. We already discussed inventory in previous lessons, our apples in apple business, or produce when we discussed the biological assets, milk, wool and so on. What is inventory in broader terms? Inventory is stuff you will sell or use to make what you sell. On the balance sheet, it's a current asset, and it turns into cost of goods sold, COGS, when you sell. You will typically find inventory as a neighbor to trade receivables, cash and other current assets. That's where it belongs. There are two major distinctions of inventory by type of activity that the businesses do: retail business and manufacturing business. For a retailer like our Apple shop, we normally would have merchandise inventory, apples ready to sell. We just buy them and resell them at a profit, hopefully. For a manufacturer, for example, of an apple jam, the inventory typically looks like this: raw materials, apples, sugar, jars. Work in process or in progress, short name WIP. This will be the apples in the process of cooking, which are not apples anymore but not a jam yet. And finished goods, jam jars ready to ship to a customer. Which costs go to inventory? In other words, which costs could you capitalize as part of inventory and not expense them directly? These costs would be purchase price of inventory minus discounts, any freight in or transportation cost to bring inventory to your warehouse, including import duties. And then for manufacturers come conversion costs to make a finished product. These costs will, for example, include direct labor and a fair share of factory overheads, for example power, rent of the production hall, etc. Some costs are excluded from inventory and have to be expensed. This would include abnormal waste and spoilage, freight out costs, meaning delivery to a customer, selling and administration costs, storage after production, unless storage is needed in the process. Proper capitalization of costs in inventory is often a critical point to understand the real profitability of the business, because if you expense too much now without the sale of the finished product, your profits would be unreasonably low, and vice versa. Now, before we move on, if you find our lesson useful, please take a moment to hit a like button and subscribe to our channel. This support is very important to us, thank you. Now, how do you track inventory if it's constantly moving? Indeed, you buy and sell, and prices keep changing, and you still need to know the proper cost and profits to show. There are two major ways to track inventory. Perpetual approach. Here, you update inventory and COGS with the average sale. This provides great visibility and is very accurate. Another one is periodic approach. You update the numbers only at period end using inventory count and the formula cost of sales equals opening inventory plus purchases less closing inventory. This way you say that your cost is basically the difference between what you had before, what you bought on top of that, and what you sold from these two categories, a rolling number. But you may ask, if I bought inventory in a few batches at different prices, how do I know which price to use as cost of inventory when I sell a product? And this is a very important question. When identical items have different purchase costs, you need a cost flow method. And there are four major of them. The first one is a so-called FIFO method, which means first in, first out. You say that the oldest batch is sold first, and then ending inventory includes the most recent purchases. You move from the back to front when clearing your stock. The second method is weighted average. You take the total cost of total purchases and divide them by total units, and you get a single average unit cost. When you make a new purchase, you add the cost of purchase to existing inventory, add the units, and recalculate the average price. This approach smooths costs. The third method is specific identification. It is used for unique items, for example designer bikes, artwork, etc. And the fourth one, a so-called LIFO, meaning last in, first out. Opposite to FIFO, you say that you first sell the most recently bought goods and then the oldest, moving backwards. But be very careful, this method is not allowed by IFRS, but it is allowed under US GAAP in some cases. But again, better not use it to avoid problems. When do you use which method? FIFO feeds perishable goods and shows current inventory at near current cost. Weighted average at the same time stabilizes margins when purchase prices jump around. Let's have a look at those two methods using an example of our apple shop. Back to work. Let's say we buy 100 kilograms of apples at $1 per kilo, which means $100 in total, and get it to stock. We pay in cash. Journal entries would be debit inventory 100, credit cash 100. In 1 week we buy another 100 kilograms, but now at $1.20 per kilo. That would cost us $120, again paying in cash. Journal entries would be debit inventory 120, credit cash 120. In total, we have accumulated 200 kilos of apples with a total cost of $220. If you run it through T accounts, it will look like this. Cash, 2 credit entries of 100 and 120, total of 220, and inventory, 2 debit entries totaling 220. A customer comes and we sell 120 kilograms. But now at which cost? First, we look at FIFO method. Under this method, we sell the first 100 kilograms at $1 each, total of $100, and the first batch is fully gone from our inventory. But we need 20 kilos more, which we take from the second batch at $1.20 each. This will cost us $24, and our total cost of goods sold will be $124. Journal entries would be debit cost of sales 124, credit inventory 124. Ending inventory would be 80 kilograms from the remaining batch at $1.20 per kilo, which is $96 in total. And that's exactly what you end up with in a T account of inventory after crediting it by 124. And what happens under weighted average method? Here we calculate an average cost of every kilogram we have purchased. It would be $220 divided by 200 kilograms and will result in $1.10 per kilogram. When we sell 120 kilograms of apples, our total cost of goods sold would be 120 times 110, which is 132. This is higher compared to FIFO, as we are distributing more expensive apples from the second batch overall inventory. Journal entries would be debit cost of sales 132, credit inventory 132, and ending inventory would be 80 kilograms times $1.10 equals $88. When you sell all your inventory, totals will be the same, but different methods distribute the cost differently in time. When you run the business, it is common that some inventory gets lost, spoiled, or the selling prices drop too low and you cannot recover the costs. To reflect the real value of inventory at each reporting date, inventory is valued at the lower of its cost, what you capitalized, or its net realizable value, NRV, the selling price minus costs to finish and sell. If NRV drops below your cost, for example apple bruised, prices fall, you will need to write inventory down and take an expense. Let's say you had 100 kilograms of apples you bought at 1.2 per kilo, and now the selling price is 1.1. That means your total cost of apples is $120, but you can recover only 110. And in accordance with accounting principles, you cannot have overestimated assets on your balance sheet. You need to write down the difference between 110 and 120, which is 10. Journal entries would be debit inventory write-down as an expense in the income statement and normally as part of COGS, 10. Credit inventory, 10. Under IFRS, if net realizable value later recovers, you can reverse the write-down up to the original cost. But be careful, it cannot be more than the original write-down. Under US GAAP, reversals are not allowed. Normally, in addition to tracking the value of inventory items, you would also do an inventory count, or stock take, to confirm the number of units you have left in inventory. Even with a perpetual system, you should do regular counts. Differences from theft, spoilage or errors are shrinkage, and you need to adjust inventory down and expense it. Of course, if you find the items later, you put them back in stock, increasing assets and recording an income in the P&L. Counts keep your books honest. Now, how does inventory hit the three statements? On balance sheet, inventory sits in current assets. In income statement, when you sell, the cost leaves inventory and becomes COGS. In cash flow, indirect method, if inventory increases, it has a negative effect, as you use more cash to buy more. If inventory decreases, it has a positive effect as you sell more inventory than you buy and it releases cash. What are the ways to analyze inventory? There are different KPIs, but here are the main two to watch. Inventory turnover, which shows how fast the inventory moves, and it equals cost of goods sold divided by average inventory. Higher usually means fresher stock and less cash tied up, but may also result in higher risk of stock outs. Days of inventory outstanding, DIOs, equal inventory divided by annual cost of sales multiplied by 365. Alternatively, you can do that monthly, and then the formula would be inventory divided by monthly cost of sales times 30 or 31 days. This KPI shows how many days the stock sits for before it's sold. For example, if you have $120 of apples in stock and your cost of goods sold for the last 12 months was $1,000, your DIOs would be 120 divided by 1000 times 365 equals approximately 44 days. That means it will take you roughly 44 days to sell your current stock of apples. What are the common beginner mistakes to avoid in inventory accounting? The first one would be capitalizing freight out or selling costs, which are expenses. The second one is forgetting to allocate manufacturing overhead into work in process or finished goods. The third one is mixing up periodic and perpetual entries. The next one, using LIFO under IFRS, which is not allowed. Skipping counts and discovering huge year-end surprises would be the next one. And the last one, ignoring write-downs when net realizable value falls. So, a good lesson, let's summarize it. Inventory is a current asset that becomes cost of goods sold when it is sold. Put in product-related costs, expense selling and administrative costs now. Choose a cost flow method. For example, FIFO or weighted average are good for most businesses. Value at lower of cost or net realizable value. Write down if needed. Count regularly and track turnover and days of inventory outstanding. Thank you for watching this video. If you enjoyed this, hit like, subscribe and ring the bell so you don't miss the next lesson. See you soon and keep those debits equal to your credits.